This mortgage broker has worked in the industry for 27 years. In recent months, he's seen an increase in people wanting to take on more debt than they can chew.
There's a bit of FOMO, the whole fear of missing out is creeping into the market at the moment. So people will kind of do whatever they need to do at the moment to get into the market so I don't miss out. Sometimes it's first home buyers, sometimes it's investors, sometimes it might just be like a family trying to upgrade.
To stop risky housing lending, the banking regulator APRA has set new limits. Under the changes from February next year, lenders can only sell 20% of new mortgages to buyers whose debt is 6 or more times their income. At present, it's sitting at 6% across all loans. That includes about 10% of investor loans and nearly 4% of owner-occupier debt.
These changes are coming in as a bit of a guardrail against what APRA sees as some higher risk type lending. It's not so much about where we are today, that share still remains quite low, but protecting ourselves against where we might get to in terms of systemic risk.
The limit excludes bridging loans for owner-occupiers and loans for the purchase or construction of new dwellings.
It's going to push people to new properties, new builds, new properties, which tend to be in the outer areas of all the capital cities, but maybe also, your small developments and things as well. So, because then they're suddenly exempt from those rules. The biggest impact is probably likely to be on investors in the market. Investors might already have maybe a car loan and maybe a home loan. So if they now want to add an investment property to the mix, they're going to start exceeding, those debt to income ratio caps.
This is not the first time APRA stepped in. It reined in lending just over a decade ago to crack down on risky loans in the wake of the financial crisis. But a second round of restrictions on interest-only mortgages a few years later was quickly reversed, considered too heavy-handed at the time.
This is a bit of a different change to what we saw in 2017. And the reason for that is those changes in 2017, which put a cap on interest-only lending, were actually quite binding. The share of loans that were interest only at the time was well above the cap that APRA introduced. That's not the case for this cap that's being introduced. We're actually well under the cap at the moment, so it's unlikely to have anything like the effect we saw in 2017.
APRA's latest lending restrictions follow data showing that investor borrowing has been increasing much faster than lending to owner-occupiers. In its October Financial Stability Review, the RBA warned that investor loans may prove to be at greater risk of default in a severe downturn.
It may dampen momentum a little bit at the margins, given it will constrain some investor activity. That said, we're still expecting that we're going to continue to see home price growth next year, much as we have this year.
The latest handbrake to cool what many see as an overheating housing market.
I sat down with APRA's chair, John Lonsdale, in his first TV interview. John Lonsdale, welcome to The Business.
It's a pleasure.
Back in 2014, APRA did consider debt-to-income lending limits, but decided against it. Why is APRA doing this now?
So the situation in 2014 is quite different to what we're seeing now. In 2014, what you saw was high debt levels that were increasing. You saw subdued income levels. You saw deterioration in lending standards across a range of fronts, particularly underwriting standards, high LVR, high DTI. What we're seeing now is aggregate lending standards remain sound, but there are some early signs of some risks that we're worrying about, and that's particularly on what we call high debt to income lending. And so what we're doing today, what we've announced today, is that we will introduce a new tool that targets this particular risk. So not wholesale investor lending, but a particular risk for high debt to income lending for both owner-occupiers and investors.
And that limit is 20% for both of those groups. Is that to ensure that one doesn't crowd out the other?
So the way that we've applied it is one limit, 20%, but as you point out, there are two groups, and that is right. So one group doesn't crowd out the other. That's very important. At the moment, what we're seeing is we've got the 20% limit, but at the owner-occupier level, it's around 4%, high DTI, and stable. Whereas for investors, we're seeing 10% and growing. So we would expect, while there's still a bit of headroom between what we see now and the limit, we would expect to see that binding for investors before owner-occupiers.
And with investor loans back above 40% as a proportion of lending in general in the home ownership space, is this targeted at investors because of that high level of investor lending that's happening at the moment? Is that the main concern?
So I wouldn't say it's targeted investors, it's targeted high debt to income lending, whether it's owner-occupier, whether it is investors. But as I mentioned earlier, on the investor side, that is where we're starting to see the earlier signs of things that would concern us.
When it comes to the high debt to income loans that we're seeing, are there particular institutions that are of concern?
Well, I don't want to comment on specific institutions, but in aggregate, as I mentioned, there's quite a bit of headroom between where we are and what the limit is. Having said that, there are some entities that are much closer to that limit than the average. And so we would expect for those entities, they'd be looking very carefully at what we have announced today, and we would expect those to be binding on those in the foreseeable future, the not too distant future.
Are those big institutions or are they at the smaller end?
Well, as I said, Alicia, I don't want to comment on who it is, but there will be some that are affected earlier than others.
Now, APRA obviously works as part of the Council of Financial Regulators, which includes the RBA. How much consultation was done with the RBA and the government potentially around this ahead of today's announcement?
So we've had a lot of discussions. So as we've moved into a different part of the financial cycle, there were several discussions at the CFR level about what that might mean for risk. You might recall back in July when we issued our macroprudential settings paper then, we made reference to some emerging risks. We've taken the period between now and July to actually talk to entities, develop further thinking with the CFR as well. So there's been a lot of thinking that's gone through this.
How will this action help or hinder first home buyers given the government's first home buyer deposit scheme?
So what we want to do is make sure that the lending that happens in the economy is good quality lending. And so we're particularly targeting high debt to income lending. If we're successful at that, we'd expect good quality lending to keep happening through the economy, and I think that's good for borrowers of all sorts. When you particularly look at first home buyers, we'd expect them to be less affected by what we're doing here because first home buyers, the issue is more leverage rather than debt to income. This is something that probably will affect investors more at the margin.
And of course, supply of housing is an issue in Australia. This is very much targeting or leaving out. Supply of housing in Australia is an issue. This is leaving out new home buildings. Is that on purpose?
It is on purpose. So we've got a broad tool. We've tried to keep it simple, but there are some exclusions. Housing new builds is one of the exclusions, and housing supplies, you note, is a very important public policy issue in Australia, so we don't want to interrupt that. Bridging finance is another one. So we've looked very closely at that to make sure that what we've got here is a tool that targets the specific risk that we see in a forward-looking way that, to the best of our ability, doesn't get in the way of other very important public interest issues.
And you did flag the potential for further action. What could that look like?
So we, twice a year, look at our macroprudential settings. I don't want to forecast what we may or may not do, other than to say our job, our mandate is to keep the system safe. We're always on that. If we see emerging risks, we will act, and you can see that today we were acting preemptively. So we will act, but we've got a broad range of tools at our disposal.
John Lonsdale, thank you so much.
Thanks very much, Alicia. Thanks for having me.